Hi everyone, this is Phil Yeager. I want to welcome you to Module 7b, which is on page 88. That is error correction. Now, you can have errors where, for example, very simply, all right, you may have office expense and you charge it to rent expense. So you have to reclassify it. That's one type of error. But the most popular one that they like to ask are what we call counterbalancing errors, dealing with inventory. For example, let's assume it's 2007 and my ending inventory is overstated by $1. Now, if ending inventory is overstated by $1, how does that affect cost of sales? Well, if I have $1 too much of inventory, that means that I sold less. All right? Then my cost of goods sold is what? Understated by $1. Now, if cost of goods sold is understated by $1, all right, my net income is overstated by $1, and retained earnings also is overstated by $1. Now, next period, 2008. My ending inventory becomes my beginning inventory, which is overstated by $1. Now, beginning inventory is a cost of sales account. So if beginning inventory is overstated, my cost of sales is also overstated by $1. Now, if cost of sales is overstated, net income is what? Understated by $1, and then retained earnings would be understated by $1. So notice, any error in the ending inventory at the end of 07, all right, will correct itself, all right, by the end of 12/31 of 08. All right, so therefore, retained earnings is corrected, all right, and that's the key thing. So a counterbalancing error actually will correct retained earnings. Now make sure you know the effects on how ending inventory affects overstating net income, all right, and also how it affects retained earnings. Now let's go to page 89 in the book. All right, let's go down to the 1, 2, 3, 4th paragraph on the top. FASB 154 defines accounting errors as errors in recognition, measurement, presentation, or disclosure in the financial statements. An error can occur from mathematical mistakes, mistakes in applying GAAP, and oversight of facts that existed when the financial statements were prepared. A change in accounting principle from a non-GAAP to a GAAP is a correction of an error. An error in the financial statements is treated as a prior period adjustment by restating the prior period financial statements. All right? So you have to what? Restate the prior period financial statements. The cumulative effect of the error is reflected in the carrying amount of the assets and liabilities at the beginning of the first period presented, with an offsetting adjustment to the opening balance in retained earnings for that period. Financial statements for each period will then be adjusted to reflect the correction of the period-specific effect of the error. Now also, footnote disclosures should disclose that the previously issued financial statements were restated, along with the description of an error. So what do you have to do for footnote disclosures? Disclose that the previously issued financial statements were restated with the description of the error that caused them to be either over or understated. In addition, the line item effects of the error and any per share amounts must also be disclosed for each period presented. Footnote disclosures must also indicate the cumulative effect of the change on retained earnings and other components of equity or net assets at the beginning of the earliest period presented. Okay? All right, just read that. And then the easiest way to show this is to go to multiple choice. Now, I want you to do multiple choice number 1 on your own. But let's look at number 2. Number 2. It says here, during 08, Paul Company discovered that the ending inventories reported on the financial statements were incorrect by the following amounts. 2006 was understated by 60. 2007 was overstated by 75. Paul uses the periodic inventory system to ascertain year-end quantities that are converted to dollar amounts using FIFO cost method. So they value inventory at FIFO cost. Prior to any adjustments for these errors and ignoring income taxes, Paul's retained earnings at January 1st, 08 would be what? Now, we have an error at the end of 06. So at the end of 12/31/06, the ending inventory, all right, at 12/31/06 was understated. That will correct itself, all right, by the end of 07. Remember I just showed you that? Now, what happens to our ending inventory for 12/31/07? All right, now, for 12/31/07, our ending inventory was 75,000 overstated. All right, now, if ending inventory is overstated, all right, now, what will happen to, all right, the net income and cost of sales? All right, first of all, if ending inventory is overstated, all right, we would say cost of sales would also be what? All right, if we have more inventory than we really sold, all right, then our cost of sales is understated by 75,000. Now, what's the deal with net income? If cost of sales is understated, net income is overstated. And if net income is overstated, retained earnings at December 31st, 07 is also overstated. Now, this retained earnings, all right, at 12/31/07, which is overstated by 75,000, becomes our beginning retained earnings at 1/1/08, and that would also be overstated by $75,000. Now, what is it asking for here? It's saying Paul's retained earnings at January 1st, 08 would be 75,000 overstated. All right, my answer to number 2 is C as in Charles. Good. All right, now let's go to number 3. TAC reported a retained earning balance of 150 at December 31st, 07. In June of 08, TAC discovered that merchandise costing $40,000 had not been included in inventory in its December 07 financial statements. All right, TAC has a 30% tax rate. What amount should TAC report as adjusted beginning retained earnings in its statement of retained earnings at December 31st, 08? All right, now, we go once again to our ending inventory at December 31st, 07. Now, according to what it's telling us, all right, is that TAC, all right, had $40,000 inventory that had not been included. So our ending inventory was understated by 40,000. Now, if ending inventory is understated, then cost of sales is overstated. And net income would be what? Understated. And retained earnings would be what? Understated by 40,000. Now, when you have a prior period adjustment, which is an error, the error here was they failed to include inventory at the end of 07. All right? You must show a prior period adjustment on the financial statements. All right? And you know they're asking the financial statements because they're saying what amount should TAC report as adjusted beginning retained earnings in its statement of retained earnings at December 31st, 08. All right? Now, you want to show that net of tax. All right? So what we do is this. All right? We take our retained earnings, $40,000. All right? Now, we're going to adjust, all right, we're going to adjust our beginning retained earnings. Now, my beginning retained earnings was $150,000 at (1/1 of 08), and it was, let me move this over more. Beginning retained earnings at 1/1 of 08, all right, was, I believe it was $150,000. Now, we know that our ending retained earnings was understated at the end of 07 by 40,000. So therefore, All right, this becomes our beginning retained earnings, understated by 40,000. So if it's understated, all right, we have to increase retained earnings by 40,000 net of tax. All right, now what's our tax rate? Our tax rate is 30%. So net of tax would be 70%, all right, times 40,000, and that would be $28,000. So therefore, our adjusted beginning retained earnings at 1108 is $178,000. All right, and that will be answer B as in boy. All right, now I want you to do on your own question number 4. All right, now let's look at number 5. Lord changed from the cash basis of accounting to the accrual basis of accounting during '08. The cumulative effect of this change should report in Lore's 2008 financial statement is what? When you change from a non-GAAP to a GAAP, that's considered a correction of an error. All right, so the answer should be A. All right, 5 is A. Okay? All right, now let's look at number 6. Bren's beginning inventory January 1st, '08 was understated by 26, and its ending inventory was overstated by 52. As a result, Bren's cost of goods sold for 2008 was what? All right, now, let's see what we have here. Now, this is not a counterbalancing error question because it deals all with 1 year, '08. Now, let's look at our beginning inventory at 1108. Now, the beginning inventory is understated by 26,000. Now remember, beginning inventory is a cost of sales account. So beginning inventory is understated, then what? Cost of sales is understated. If cost of sales is understated, net income is what? Overstated. And then retained earnings would be overstated. All right? Now, the next thing they tell us is, during that same period, the ending inventory is incorrect for '08. All right? Now, what's the deal here? The ending inventory is overstated by 52,000 for 2008. Now, if ending inventory is overstated, you had more inventory than you sold, then your cost of sales would be what? Understated, all right, by $52,000. Now, if cost of sales is understated, then net income is what? Overstated by $52,000. And retained earnings is overstated by $52,000. All right, now, the question wants to know here. Let me put this here. 26, 26, 26. All right, the question wants to know. All right, as a result, Bren's cost of goods sold for '08 would be what? All right, well, the beginning inventory is understated by 26, and the ending inventory is understated by 52. 52 and 26 gives us a total beginning and ending inventory understated by $78,000. All right, I like letter C. 6 is C. All right? All right, now let's go to number 8. Net income is understated if in the first year estimated salvage is excluded from the depreciation computation when using what? Now, the first question is this. For straight line and the units of production method, do you subtract salvage? And the answer is yes. You subtract salvage for the straight line method, the units of production method, the sum of the years method, but you don't subtract it initially for declining balance. All right? So therefore, they're saying here, salvage value was excluded. So the asset was overstated. All right? Asset was overstated. Now, if the asset was overstated, the depreciation was also what? Overstated. And the net income was understated for both methods. Let me repeat that. All right? If you don't take salvage here, you're taking too much depreciation on the asset. If you're taking too much depreciation, then my net income is what? All right? Understated. And if my net income is understated, all right, then my answer would be B for number 8. All right? B for number 8. Now, all right? Now, that's the questions, all right, for correction of an error. Obviously, it's not a big, I'm sorry, I left off 2 questions. All right, number 13 and number 14. All right, I apologize. Number 13. Justin discovered an error in their 2008 financial statements after the statements were issued. This requires the cumulative effect of the error is reported on the 2009 income statement as a cumulative effect of a change in accounting principle. All right. First of all, this is an error. It's not a change in accounting principle. All right. B, the cumulative effect of the error is reported in 2009 beginning balance of each related account. All right. But also, all right, it affects the income statement. All right, and it must be disclosed. All right. So the cumulative effect of the error must be disclosed in the income statement. All right. Let me repeat that. That's not correct. All right. The cumulative effect, all right, has to affect also the income statement. All right. So you have to show the effect on the income statement, and also, all right, you have to disclose how it affects the income statement. All right. So that's wrong. How about this one? C. The financial statements are restated to reflect the correction of the period-specific effects of the error. All right. Well, that's the correct answer. All right. Because if you discovered an error in 2008, then the financial statements have to be restated to reflect the correction of the period-specific effects of the error. All right. And number 8, an adjustment to beginning retained earnings? No, that's not an error. It's not an error. All right, number 14. During 2009, Kelly discovered that the ending inventory reported in 2008 financial statements was understated by $10,000. How should Kelly account for this understatement? All right. Now, let's look at letter A. Letter A says, adjust the beginning inventory balance in 2009 by $10,000. Well, answer A is incorrect because although the beginning inventory may be adjusted, prior year's financial statements must also be restated. All right? Now let's look at B. Restate the financial statements with corrected balances for all periods presented. That's the correct answer. Let's look at C. Adjust the ending balance in 2009 retained earnings. All right? C says it's incorrect because correcting the balance of ending retained earnings is not sufficient disclosure for an error correction. And D says make no entry because the error will self-correct. All right? That's incorrect because even though it is a self-correcting entry, financial statements have to be restated with period-specific effects of the error. All right? This is all per FASB 154. All right, so the answer 14 is B. Now also, on your own, do multiple choice number 12. Now, in here, all right, as far as simulations, all right, let's go over on page 96, all right, simulation problem number 2. Simulation problem number 2. And that is on page 96. All right, now, let's go down to, all right, it says on the bottom of page 96, identify whether each of the following statements is true or false. Accounting errors are reported as adjustments to the end-of-year retained earnings in the current year's financial statements. All right, well, why is that false? Because accounting errors are adjustments to what? The beginning retained earnings, not the end-of-year retained earnings. All right, so number 1, let's just read the answer on page 103. Accounting errors reported as adjustments to beginning retained earnings. All right, now let's go to number 2. A self-correcting error need not be reported as an error if it has corrected itself in the current year. All right, well, that's false because a self-correcting error need not be reported as an error if it's corrected itself in the current year. All right? So therefore, it's not an error if it corrects itself. So that's false. A change in depreciation method is treated as an error when adjusting the financial statements for the current year. All right? Well, that is what? False. A change in depreciation method is a change in accounting principle. All right? Number 4, an accounting error is treated as a prior period adjustment? That's true. All right. Number 5. A change in the useful life of assets in calculating depreciation, all right, is treated as an accounting error, and accumulated depreciation is adjusted to reflect this error. All right. That is false. All right. If you have a change in the useful life of the assets in calculating depreciation, all right, what you treat it is on a prospective basis. So what you do is you take the book value up until that date and divide it by the estimated number of remaining years, and that will be a new depreciation expense. All right? So therefore, look at that simulation part number 2. And, all right, here's another part I want you to do. All right, on page 97, I want you to do, all right, this analysis of the error, 1 through 7. All right, do that on your own. All right, and then, all right, and the end. All right, on the bottom of page 97, there is a written communication, all right, which says, write a brief memo to the CEO of Cardaff Company explaining accrual basis accounting and the most common errors that must be corrected before issuing financial statements. All right, so just read the answer. Read the answer. Okay? All right, and let me see what else here. All right. See, on top page 98, they say use the financial accounting standards to answer the following question. Select the appropriate guidance from the literature. Research. What's the definition of an accounting error? Now, you can practice this because once you get your notice to schedule number, all right, the AICPA gives you the use of the literature for 6 months free. All right. Now, if you don't know how to get to that, all right, please call our instructor hotline. In fact, if you don't know how to get to that, all right, I want you to email this. Email email John at Yeager CPA Review.net. Don't forget to spell Yeager right. Y-A-E. Now, John, all right, John, do we, when we send out the package, do we show them where they can find, all right, the link, okay? All right, that's in the what? All right, the thing that says the Uniform CPA Exam Alert, all right, we mail that out with you in the package. And what page is that on, John? Can you find it off the top of your head? All right. Let me just get this here. All right. All right. Now, on page 5, all right, John, this is a fall 2008 Uniform CPA Exam Alert. I know the other courses don't give you this. All right. Now, if you look at where it says on the page 5, on the right, more information, the new CBT e-page on the CPA exam website, all right, and at cpa/exam.org contains information on an invitation to comment, description, questionnaire distributed. Okay, it also includes a link to the exposure draft of new CSOs, SSOs. All right. Also, I think, doesn't that give them the FASBs too? All right. It gives them. All right. So therefore, what will happen is, all right, go to this cpa/exam.org. All right. You'll have to give them I'll put it on the board. Okay. All right. All right. You'll be getting this in your package. But although you get it in your package, people call up and they say, we never got it. All right? All right, here we go. Go to CPA/exam, all right, .org. All right, and by the way, that's www. All right, is that correct? And, all right, look where it says you have, first of all, you're going to have to give them your notice to schedule number. All right, it takes a few days, and then you gain access to the literature. And guess what? Then you can go to page 98 and, all right, find the appropriate answer to this question. What's the definition of an accounting error? All right. Now, you'll have to use, sort of a search. All right. All right. So what I would put in is accounting error. All right. And that should take you to it. And then it'll give you the definition of what an accounting error is. All right. And that should be FASB, I think it is 154. All right. That's FASB 154. Now, of course, if you knew FASB 154, that number, all right, you just type it in, and it'll take you right to where they want. However, there's no way you're going to memorize all the FASB numbers, okay? All right, but here is your invitation to, all right, do the research, practice it. And once again, it is in the Uniform CPA Exam Alert, page 5, on the bottom of the handout, more information, all right? And here is the link, www.cpa/exam.org, all right? And it will show you, right in accounting error, should take you to FASB 154, and just go to the right paragraph, okay? All right, we try to do everything we can to help you, all right? Don't get panicky about research. So anyway, that is Module 7b, error correction. Perhaps they'll give you a question on that. I wouldn't go crazy. Good luck, and thanks for your time.